Hello, it's Kay Osborne again. I promise next week I'm going to get better about there not being a PowerPoint in front of my face or me being in front of the PowerPoint, but I'll figure it out, and I promise these videos will get better. In the first video, I talked you through the generalities of accounting, generally accepted accounting procedures, internal users, external users, and now we're going to move on to the accounting equation. This is pages 15 through 20 in your textbook. So as you're reading, you'll know where this video follows the textbook. So we're going to start talking about the accounting equation and keeping it equal. The accounting equation, memorize this. Memorize it today. It's your first task in this accounting class. Assets equals liabilities plus equity. Assets equals liability plus equity. Assets are what the company owns. Liabilities plus equity is how they paid for it. So assets are cars, trucks, buildings, land, inventory, stock, anything a company owns. Liabilities is money that they owe other people, either banks or lenders. And equity is the money in the company that the owner has. So it's either contributed capital, like stock purchases from the owner, or retained earnings, which is money that the company has earned and is kept within the company and is not paid out to the owners in dividends. All right, so let's expand this a little bit. Let's say assets equal liabilities plus equity. And equity could be contributed capital plus retained earnings. Contributed capital is that money the owner paid in plus retained earnings, which is the revenue minus expenses minus dividends. All right, let's move one step further. Assets equals liabilities plus contributed capital, which is the common stock that the owner owns in the company, plus retained earnings. Retained earnings is the earnings of this company that have been kept in the company, the revenue minus expenses minus dividends. Dividends are money that is paid out to stockholders in a company based on how much stock they own. So let's go on to another slide and talk about this in terms that I hope will help you understand. Assets equals liabilities plus owner's equity. So let's talk about it in terms of you. What do you own? Something that most of you probably own is a car. Okay? So a liability is the amount of money or bank loan or loan from your parents or loan from the car company plus your down payment. This is the very simplest terms of the accounting equation, but sometimes it helps students understand exactly what it is. So let's say you purchased a car that cost $20,000 and the bank loaned you $15,000 and you made a $5,000 down payment. So your asset is $20,000. It equals your loan plus your down payment. So your assets equals liability plus owner's equity. It is important anytime we're talking about accounting that we keep this equal. The left side equals the right side. The debit side, which means left, has to equal the credit side, which means right. I had a fun conversation today, and we were talking about debit and credit, and I said I could just call the left side dog and the right side cat, and it makes the same difference. Just remember, debit always means left, credit always means right. In order to have an accurate double entry accounting system, we always have to keep our accounting equation balanced. So assets equals liability plus owner's equity. I'm going to erase this real quick and then we'll go back and we'll go through that PowerPoint again so that you can see again how it works. It's just the first and most important thing. Everything in accounting builds one upon the next. So you want to make sure you stay caught up. You want to make sure that you're staying interested, that you're doing the reading, that you're doing the homework. Sometimes it's a little bit difficult and a little bit confusing online, but I always want you to know that I'm available by email and available by phone. I will do my best to explain information to you over the phone, via email, and sometimes I'll even be happy to just make a little video for you if that helps you at all. Hopefully they become better quality than the one I'm doing today, but at least I hope it helps you understand the information and get a good start in this class. All right, so the accounting equation in transaction analysis. Anytime we change the asset side, we have to change the other side as well. Assets are what the company owns, liabilities are what they owe, and equity is the owner's contribution portion of this company. So let's just work through some transaction analysis, and so you can figure it out. These are pretty easy, kind of algebra type, and we won't be doing these all semester, but it just helps you understand. Assets are 150, liabilities are 30. That means equity is 120. If we're keeping our next transaction in balance, we have 100 in liability, 300 in equity, 400 in assets. Down below, where we're using the expanded accounting equation, we know we have 200 in assets, 80 in liabilities, and 120 in equity. So we have 100 in stock. We didn't pay out any dividends. We had expenses of 40. So what we're trying to do is we're taking that expanded owner's equity equation and making it equal $120, and that means we had revenues of 60. Same thing in the next one. We know assets are 400, liabilities were 160, equity is 240. How does everything in the expanded equation equal 240? Well, common stock was 220. That's the owner's paid in capital is $220,000. Revenue this year was 120. Expenses were 90, which means we had net revenue of $30,000. Our revenue were 30 less than our expenses. And in order to do this, we had to make a balance. Then we paid out $10,000 in revenue. So I hope that helps you understand. We're going to go through some more transaction analysis. So we talk about Charles Taylor investing $30,000 cash to start a company. We know that our assets are $30,000 because cash in a company is an asset, and we know the owner has paid in capital of $30,000. So our assets of $30,000 equal our equity of $30,000. We have no liabilities yet, but let's go to transaction 2. The company purchased supplies paying $2,500 in cash. Well, cash is something the company owns and supplies are something the company owns. So we're going to reduce the cash account by $2,500 and increase the supply account by $2,500. But our total remains the same because both of the accounts that were affected were asset accounts, so we didn't have to touch the other side of the accounting equation. We just reduced cash and increased supplies. We purchased equipment for $26,000 in cash. Well, equipment and cash are both assets. So once again, cash was reduced, equipment was increased, but still both sides of the equation have $30,000 in them. And we were running low on money, so we had to purchase some supplies on account, which means our asset side was increased by $7,100, but also our liability side was increased by $7,100. So once again, our accounting equation, assets equal liability plus equity, remain balanced. Now we're going to talk about revenue, expenses, and dividends. Remember, revenue, expenses, and dividends come under retained earnings. So we provided consulting services to a customer and received $4,200 in cash right away. So our asset of cash is increased and our revenue of equity is increased. Our revenue, which is included in owner's equity, is increased. So our company has grown. Now we are balanced at $41,300. We paid some rent. So we increased our cash. We also increased our expenses. Remember that the balance in the expense account actually increases the equity. It decreases the equity side. I'm sorry, it does not increase equity. It decreases, but it increases the cost of expenses. So both sides are dropped by $1,700. We provided consulting services of $1,600 and rent of facilities for $300 to a customer for credit. So accounts receivable is money that another company owes us, and that is a asset account. The second is consulting revenues. That's a revenue account, so it's money that increases our equity. And rental revenue also would increase our equity. So at the end of this transaction, it increases both sides of our accounting equation. You're going to have to sit down. I'm going to be talking about assets, liabilities, owner's equity, revenue, and expense accounts. And you're just going to have to memorize and figure out what those are. So a client in transaction 8 pays $1,900 for consulting services. Remember that we had an accounts receivable because that company owed us money? Well, we're going to receive cash, which is an asset, and we're going to reduce accounts receivable, which also is an asset account. So only the left side of the equation changes, but it stays in balance with the right side of the account. I think I'm going to sneeze in at least once in every video. I'm sorry about that, but let's move forward. So fast forward, our company pays $900 as partial payment for the supplies purchased in transaction 4. We owe an accounts payable. Accounts payable is a liability. It's money our company owes someone else or a lender. So we're going to reduce our asset of cash and reduce our liability of accounts payable. As you can see, our sides stay in balance. And we're going to do a couple more of these. Dividends of $200 are paid to shareholders. So we've had some profit in our company, some net profit. So cash is an asset. We're going to reduce cash, and we're going to increase dividends, paid out dividends, but that actually decreases owner's equity. So we paid out $200 in cash. We reduce owner's equity by $200, and then there's some need to know items you can work through on this. And I'm going to stop here for now because we're going to go into financial statements, and that will be the next video I have for you. So I'll be back in just a little bit with information about financial statements.